Starting out here in Texas with Amit. Amit, you're with Allworth Money Matters.
Hey guys, thanks for taking my call. I guess before I ask my questions, I wanted to paint my current financial picture.
Perfect.
My wife and I are 40 and 37 respectively. Combined gross income of $310,000 annually from our corporate jobs. We currently have $125,000 in Roth retirement accounts that we converted. That is managed by an advisor that charges 75 basis points, and invested very aggressively in genomics and innovation type companies, showing healthy returns. However, we self-manage the rest of our investments, about another 200 in IRAs, 15 in a separate Roth, all primarily invested in low-cost index funds. We have about 4,000 in a 529 plan for our two kids. And then about 20,000 in HSA that are all also invested in index funds. I maxed out my
Okay, you didn't mention a 401k in there, or are you going to?
The 401k is part of the 205 that is part of our Fidelity accounts.
Okay, thank you.
We maxed out our 401ks. Well, my wife puts 10%. I maxed out mine.
How long have you been maxing that out?
I'm sorry?
How long have you been maxing that out?
For the last 2 years.
Okay.
We consistently save about 15 to 20% of our net pay from our corporate jobs. And then beyond that, we own two daycare businesses. One is operational that we are expecting to see about $120,000 annually going forward. Second one's under construction that once it's fully operational, we'll get about $150 from that, and then my wife will manage that at a $65,000 annual salary.
And is that where your cash has gone? Because you make a relatively good wage, and you don't have a lot saved relative to what your wage is.
Correct. The majority of our cash went into putting the down payment in for the new business, which was around a little under $300.
Do you own the property or just the business?
The first one we own, both of them we're going to own the property and the business.
Okay.
So we have some concerns, particularly regarding our VUL policies that we have with our current advisor. We were sold that given our income, we would be phased out, and this would provide you with an opportunity to put more money, almost Roth-like. We do the VULs.
It's variable universal life for the rest of the
outside of the cost of insurance. All of that goes into S&P 500 index, and we fully participate. We're not capped, and there's not a floor. We're worried about the high fees that our current investor is charging, along with just the high fees related to VULs.
Yep.
Our goal is to build a legacy for our children, as well as save for their college and weddings at some point. So my questions are: one, are these VULs truly beneficial, or is that money better deployed elsewhere given our concerns and our goals? The second question is, should we consider switching advisor to somebody that's a little more proactive from a tax planning perspective and keeping track of our goals? And then my third question is, how would you structure our business entities so that they're a little more tax efficient, as well as allowing us to maybe take advantage of depreciation or how we should think about the management salary that my wife is ultimately going to get?
Yeah.
Got it.
Great questions.
And what is your wife's income? You refer to these corporate jobs. Your wife works for a large corporation now?
She works for a marketing consulting company, and I work for a renewable energy company.
And what is her income now?
She makes about 95, and then I make about 180 plus my bonus.
And then you mentioned that she's going to leave that and just run the daycare at $65,000 a year. Is that correct?
She's going to keep both.
Okay.
She'll manage, we'll hire directors, but she'll be there from an owner perspective.
Okay.
The plan is to ride both of them as much
By
as
the way,
possible.
Wealth is created not in passive financial assets like S&P 500, 401k, VUL. Wealth is created in your career. Either you're very talented and somebody pays you a boatload of money, or you create a business.
Or in your case, both.
I mean, if you look across the spectrum of wealthy people in this country, it's very few is it's inherited. It's primarily in your career, either a business or you're really good at what you do.
What did you say was in the 529 plans?
Let me rephrase that. You're really good at what you do in an area that demands a high wage, because you might be a great violinist and you bring a lot of joy to people's life, but maybe you're not making
this follow your dream stuff is garbage.
Well, I don't know. Garbage.
Okay.
You need to get paid too.
The 529
the
plan.
intersection between getting paid and your dreams.
Well, how much is in the 529 plan?
About 4,000.
Okay. And let's dig into this VUL.
Yeah.
What's the...
So first, variable universal life policy, the way they're structured, like Pat and I both started in the industry with a life insurance company, 1989 and 1990. We lasted a couple of years. We learned that if you get trained in the life insurance industry, they teach you that life insurance is the solution for any financial issue you're dealing with. I don't care what it is, a life insurance policy is the answer, right? That's how they train all their agents and whatnot. A variable universal life policy is a policy where you put money in to this pool. You can choose how it's invested. So you've chosen to put it in the S&P 500 fund. And then there's a cost of insurance. There's a life insurance, like a death benefit. And how much is your death benefit on your policy?
For the parents, it's $500,000. For the kids, it's $1 million.
Wait, whoa.
How many policies do you have?
Each of the family members have a policy, and then we as parents also have a separate $1 million term policy.
Okay, and is it the same advisor that sold you this that is actually managing the Roth IRAs?
Part of them, yes.
Yeah, the one.
Okay, so let's break down all four policies. When did you purchase these?
Well, let's explain how these work.
Okay, well, thank you.
$500,000 a death benefit on Amit's first policy he's talking about here. And so if there's no cash in there at all, he has an insurance cost of whatever the insurance cost would be for $500,000 of death benefit. Mm-hmm. If he had $100,000 of investments and cash in the policy, he would pay the amount of death benefit would be the difference between that $500,000 and what he's got saved there. The cost, my experience, by looking at the cost of insurance on these policies, it tends to be a lot more than it would be on pure term insurance.
Yes. So what they call that difference the Delta pure insurance, and that pure insurance is expensive. And once you're in, you can't requalify because they have big surrender. Most of them have big surrender charges.
Plus, there's the internal costs are 2-3% a year.
There's a load on it typically, and then there's a management fee inside.
Now the benefit, what they sell the benefit on these is they grow tax deferred, so you're not taxed at all as things grow. And then when you die, that's tax free. But later in life, you can withdraw your contributions first, your policy premiums first. And then after that, you can take out a loan against the policy.
And as long as you die with the insurance policy in place, it's tax free. The problem is most people don't die with these insurance policies because the costs actually erode most of the value in there.
The whole concept of using these policies, funding them, and then in life taking a withdrawal, I can't tell. I've been doing this 35 years. I cannot think of one situation where I saw someone with a sizable nest egg in a life insurance policy living off the loans from it.
Well, Scott,
I've seen where they're about to implode. And and if they collapse on themselves before you die, suddenly it triggers a massive taxable event of all that.
I have one client that who's a retired doctor that his VUO is extremely well funded. I didn't implement it for him. He came to me. We actually lowered the face value and increased the deposits in order to buy less pure insurance in there. And as you can imagine, someone that saves that well typically won't ever have to use the VUL.
That's right.
We won't use this VUL, as said. So let's break down all four policies. You said you and your spouse each have $500,000?
Correct.
And what's the cash value in there?
The cash value for mine is around 65, and the cash value for my wife is around 20.
And how much you putting into these?
Right now, we're putting $500 a month for each person.
Okay. And you then mentioned that you had 2 policies, one on each child.
Correct.
And what's the face value on those?
They're $1 million, and we're putting in $300 a month for each child.
Holy smokes! Look, whatever.
How much cash is in those?
My eldest has a good amount, a little north of 30, and my youngest has been recently born, so he doesn't have much. My
experience has been the internal cost of the insurance is more than the tax liability would be.
And why would you buy an insurance policy on a child?
Because it's such a great tax tool.
But the 529 is completely ignored in this equation. There's $4,000 in the 529 plan, and they're putting $300 a month into these policies for these. So this answers
these do have extremely high YTBs,
yield to broker. So
that's why I'm thinking about lowering my kids' death benefit to half of that, and then deploying that capital into a 529.
I'd cancel the children's.
What's it costing you?
For the minimum amount is relatively marginal. I think it's $1,200 a year.
Yeah,
that's not marginal.
Yeah, so
you can buy a term life policy for less than that on those kids. I don't know why you'd need $1 million of life insurance.
Let's step back for a minute. First of all, you're an incredible saver, and you're doing really well. I would have at age 40, I wouldn't worry about.
Well, they kind of like a couple businesses going. You're doing all the right things.
You're doing, yes.
I assume you don't have a bunch of debt. My guess is you don't have a $150,000 loan on a boat. A wake boat.
I don't have any debt outside of my mortgage, which is that 30-year 2.5%.
Of course it is.
And my car, which should be paid out within a year or two.
Okay,
at 4%.
So I asked the question earlier. To the advisor that's managing your Roth, you said 75 basis points, right? 0.75%. Is he the same one that implemented the life insurance policies?
Yes.
Sold you the policies.
Fire. Your question was, should I change my advisor? And the answer is yes.
You know, it's funny. As you first started the call and you said he's charging you 0.75 of a percentage point to manage a $125,000 account. You have assets elsewhere. I'm thinking, this guy's working for peanuts.
$900
Why would
a year.
Why would he work for you at such little pay? If he's a good advisor, he can demand a better pay than. And now it understands why, because he's made a ton of money.
So here's what I would do. Here's what I think you should do. Cancel the policies on the kids immediately and consider it sunk cost. You're going to lose most of the money, or you could actually.
I don't know what it costs. There's a minimum cost every year.
That's
for
right.
These things.
So, but what we do
you
know,
got to kind of run the numbers.
Is the newborn, you should cancel it. The child that's got a $30,000 cash value, you might want to lower the face value to $100,000 or maybe $50,000, and that way you're buying less pure insurance, and then slow down or stop the deposits completely. But I
was trying to see what the lowest death benefit I can get to without it not being an MEC.
Oh no, you don't care if it becomes a MEC.
Okay.
You don't care. You don't care because the cost of insurance, it far exceeds any of the downsides of becoming a modified endowment contract.
Okay.
So just throw that away. In fact, even on your own life insurance,
you might want to qualify for some more insurance before you reduce.
Talking about the kids first.
Oh yeah.
Okay, so the kids. So you're on the right path. So don't just see what the lowest face value you could turn those things into.
I would look at if the surrender charges aren't too astronomical, I would just cash the thing out. It's $30,000, a couple grand in penalties. Take the $28,000, throw it in the 529. That's what I would do.
That's right.
And if you really want life insurance, I don't know why you'd want life insurance on your kid, but if you want life insurance on your kid, go buy some cheap term insurance.
You have no need for life insurance on a child. Unless this child is some sort of prodigy, is making all kinds of income that's coming into the family. Life insurance is designed to replace
Well, the
income.
amount of money we're spending on them, I expect them to be projects.
Okay. Well, I don't know. Yeah. I don't actually know.
Wait till they're teenagers.
I don't know if that's how prodigies work. I don't think you could actually spend your way to a prodigy. So on those, I agree with Scott. I'd look at either collapsing those policies completely, or at least the oldest one child turning into a mech. Your policies, I would turn them into mechs. First of all, I agree with Scott. I would actually go out and buy some term insurance. And by the way, you $500,000. How much other term insurance do you have?
He's got $1 million.
Other $1 million for each of us.
Yeah,
that's not enough.
I would have at least $2 million.
Yeah, that's not enough.
Okay.
Yeah, 2 million of term, and if you're in reasonably good health, you're 40 years old. It's cheap.
So for both those policies, your policies, I'd either lower that face value as low as I possibly could and turn it into a modified endowment contract, or cancel them completely and just take the hit. The 529 is the thing that you missed. I mean,
well, he didn't miss. He's followed this advisor.
Okay, the advisor missed, and the
advisor didn't miss. The advisor had a misalignment of his economic. I'm assuming it's a male. His economic benefits compared to Amit's economic benefit. There's a misalignment. He earned a commission.
That's right.
How can you be open-minded and actually look for the best solution when you've got this conflict, tremendous conflict?
Oh, Scott, I disagree. I kind of disagree. If he had done every other thing, let's just say that he had $2 million in the right.
Whatever.
Right. Let's just say we went through the list.
He's either uneducated and doesn't understand the other stuff. He's an idiot, or he's unethical. My opinion,
or maybe all three. But the VULs are the very last thing on the list of a product that you should use. Very last thing, right? Okay. Everything else, the 529 should be fully funded.
Look, with the tax efficiency of ETFs and a synthetic index by a direct index, like why? Those are such.
This is, as I said, the very last thing. After you've gone through every other thing, you're not there. So your idea, Amit, of either
look, he followed advice.
Understand? That's what he's calling for.
I understand.
He's calling for outside advice.
I just feel bad.
But I don't have a dog in this fight. So the 529. Look, you can convert a 529 plan to a Roth IRA if the child doesn't use it. And you talked about legacy. So these 529 plans should be maximum funded, right? All the way.
Should I have one for both or one total?
You can't. You have to have them separate.
I have two. And what I would do is just how much is it going to cost to go to education, work backwards. How much do I need to save on an annual basis?
Right.
And it's like, I remember with my two oldest kids, I had almost a perfect amount saved, but my son, what I didn't factor in is my son was in Boston, and the trips that my wife and I would take to go visit him, and then the shopping my wife liked to do when she was in Boston. So that was, I underfunded my 529 plan by that.
I don't know if 529s are designed for.
No, they were not. I'm just
joking.
I'm joking. So it was the one hidden cost I didn't foresee.
So bring those things to zero or turn them into mechs. Get $2 million term life insurance policy, 10-year level term at least on you. Fund the 529s to the maximum, and I would actually make them. I'd make them aggressive. Your wife should increase her 401k to the maximum, and you're doing the backdoor Roths. We can see that. I think you're doing great. I think I would clean that up, and I'd get another advisor.
I'm in the works of not only educating myself of the intricacies of these VULs, and then that as part of my education, I'm trying to see if I can structure my business entities optimally that allows us to take reduce taxable income at all costs.
Well, and that was your third question. So we answered the first two, right? One was the life insurance, the other was the advisor. Right. And those were actually were driven by the selection of the products. The businesses, oftentimes it depends on how many employees you have.
Yeah.
what you want to do with those.
So we don't own these outright. We're 30 or 40% partners in each of them.
Okay.
What I was considering was setting up a separate LLC that would effectively be set up for all of our business interests, whether it's in daycares or restaurants or whatever, and then paying my wife a salary through that and setting up other retirement accounts that will allow us to aggressively put money.
Yeah, it doesn't. So there's it doesn't quite work. Like there's some rules on even if you have a holding company and
beneficial ownership.
Yeah, the beneficial. It's like more than 5% or something.
In an LLC, then it flows
or
through.
An S corp, same thing. They're pass through organizations.
And by the way,
entities.
that normally I would not recommend it even if you could, because people oftentimes will focus on how do I get more money in retirement and take income rather than dividend. But the problem with taking income is there's a 15.3%
social self-employment.
It's 13.2 self-employment tax on there, which oftentimes you're better off just taking the dividend. So even if you could do that, it won't work because of beneficial ownership. So that sort of stuff you won't be able to touch. It's not gonna.
Well, setting up one entity is probably not gonna.
Yeah, and the LLC, you want that for liability. But in terms of retirement planning, there's not a lot of benefit there.
No, you're not going to get any additional because they're pass-through entities. You're not going to get any additional benefit by having some sort of holding company.
Yeah. So.
Okay, so there's really nothing else that I can do or that I'm not doing to kind of help from a year-to-year perspective.
I would simplify by these VULs, maximize both 401ks. And particularly when these businesses start becoming profitable, and it sounds like maybe the reason your wife is going to get a salary because she's the one managing the business and you have other partners. So that
makes sense.
And then I would just save in a brokerage account. And if you're going to want to have some reserves with these businesses. And
we do.
Yeah. And if you could buy the properties that the business operate in. Perfect.
We do that as well.
Okay, perfect. You know the tenant.
Okay, so I just need to fire my advisor and stop paying him. That's what I need.
That's what I would do.
Yeah. Give it some.
Is he affiliated with an insurance company?
He is, yes.
Yeah. Mm-hmm. Yeah. So all you got is a hammer. Everything looks like a nail.
Well, I'm getting ready to pull my hammer, so.
Okay. All right, Appreciate the call. Good luck to you.
See you, boys.
Yeah, all right, thank you, sir.
Take it. Hey, and by the way,
we haven't been called the boys in a long time. We were both relatively young when we started. We used to be referred to as the boys, and I haven't heard that in years, so appreciate it.
Thank you. Obviously.
Absolutely.
Thanks.
So on these insurance products, Pat, and you've heard me say before, like the world would be better if they were never created. There are clearly uses for these VUL policies, right?
I own one.
I own one as well.
Mine happens to be a super, super, super low cost.
Well, mine too. And let's be full transparency. They were designed for people who are in the industry. They stripped out all the normal costs. I think the idea was
to get us to use the
product.
product.
Get you to use the products so you would sell it to others, but
we never did that.
But the world, and the reason I don't like these policies is the way that the way the costs are structured, and the costs are. It's really an element to pay the broker, the insurance agent, right? That's these surrender charges that they have inside of these. It's just so the insurance company can recoup the amount of money they just paid for the commissions to the broker who sold the policy, and maybe recoup some of their costs of underwriting the policy to begin with. And they're so expensive, and it creates a misalignment. Here's an advisor. Maybe they want trying to do the best job, but they know, if I recommend he puts in the 529 plan, I'm going to make $82. If I recommend he buy these life insurance policies, I'm going to make $8,000. There was huge commissions paid on these policies.
Oh, there's no question. There's no question.
And I wouldn't be surprised if it was more than $8,000.
That wouldn't surprise me either. What was the
$500,000? I don't know how much. paying $500 a month.
Typically, it's at least
100% of first year premiums.
first year. So that was 6,000, 12,000.
Yeah, maybe more. He's overfunding, so
15,000. Anyway, quite a bit of money.
yeah.
But
So,
but this Ahmet's a good saver.
well, he's at first glance, had he not had the other businesses, I would not agree with you on that.
I know, but he did.
I bet he did. Okay, that's all right.